All right, today we're digging into the investment story of Kerry Group. Now, this is a huge global player in the food industry, but there's a compelling argument that the market just hasn't fully caught on to its story yet. So let's unpack that.
So let's just start with this question right here. What if a company went through this massive renovation, right? Turned itself into a high-growth, high-margin powerhouse, but its stock price just didn't quite get the memo? Well, that's pretty much the core idea we're going to explore today with Kerry Group.
So here's how we're going to break it all down. First up, we'll just lay out the core argument. Then, we're going to dive into the huge strategic transformation the company went through and, what came out on the other side. After that, we'll get into the numbers, the valuation gap that's really at the heart of this whole opportunity. And finally, we'll wrap up by weighing the potential risks against the rewards. Okay, so let's get right into it. We're actually going to start with the conclusion first, the big why. Why are analysts so optimistic about where Kerry is headed?
This quote from the source analysis really says it all, doesn't it? The conviction here isn't just that it's an opportunity, but that there's a, quote, clear pathway for the market to wake up and reevaluate what this company is actually worth.
The whole case really boils down to these four pillars. First, a massive business transformation. Second, some really powerful and lasting trends in the industry. Third, growing profitability. And fourth, and this is the big one, what the analysis calls a significant valuation dislocation. Basically, a major mispricing by the market. Let's see how these all fit together.
Now this next part, this is where the story gets really interesting. It's all about how Kerry basically renovated its entire business from the ground up.
The best way to think about this is like a strategic home renovation. Kerry didn't just repaint the walls. They knocked down the old, clunky, less profitable parts of the house to reveal this much more valuable, modern core that was underneath all along.
And look, this wasn't some overnight thing. It was a very deliberate multi-year strategy. It kicked off back in 2021 when they sold their consumer meats and meals business. Then in 2023, they sold off their sweet ingredients portfolio. And it's all set to be completed in late 2024 when they finish divesting their old-school Dairy Ireland division. It's been methodical.
So what this has created are essentially two completely different versions of the company. You have old Kerry, which was this big, diversified food group that was always getting knocked around by volatile commodity prices. But then you have the new Kerry, which is what we call a pure play. That just means it's laser-focused on one single business, taste and nutrition. And that business is built for much more predictable, high-quality growth.
So, now that the renovation is pretty much complete, what's left standing? Let's take a look at this high-value business that Kerry has now poured all of its energy into. It's a powerful and, frankly, resilient market. I mean, the sheer scale of the opportunity here is just immense. Kerry isn't playing in some tiny niche market. They're a leader in a global food ingredients industry that's worth almost $280 billion today and is projected to skyrocket to over $475 billion by 2031. That is a massive tailwind pushing them forward. And this growth isn't just some fad. It's being driven by these deep, fundamental shifts in how we all think about food. You've got the demand for healthier options, the desire for simple, clean label ingredients, you've got the explosion in plant-based foods, and of course, a huge focus on sustainability. Well, Kerry's products are the essential building blocks that make all of that possible for food companies. Now, Kerry's reach is definitely global, but its engine room, that's clearly the Americas. It drives more than half of their total revenue. This kind of geographic diversity gives them stability, but it also gives them a really strong foothold in some of the most important growth markets. Okay, so this brings us to what is really the climax of the analysis for any investor. We've established it's a high-quality, transformed company playing in a fantastic market. Now let's look at the data that suggests it's basically on sale. Here it is. This is the number at the absolute heart of the entire investment case. The source analysis shows that Kerry Group is trading at a 35 to 40% valuation discount compared to its main competitors. Look, that is not a small gap. That's a chasm. And you can see that valuation gap really clearly when you look at a key metric like EV to EBITDA. It's just a common way to compare companies by looking at their total value relative to their earnings. So, Kerry trades at a multiple of about 12.5. Meanwhile, its peers are averaging 16.5, and the industry leader, Givaudan, is way up there at over 20. The difference is just, it's stark.
So, the big question is, why? Why does this huge gap exist? Well, the argument is that the market is still applying what's called a conglomerate discount to Kerry. It's kind of like a hangover from its old Kerry days. The whole thesis is that this discount just isn't justified anymore now that the company is a focused pure-play leader. and it's only a matter of time before the market finally catches up.
Of course, no investment case is complete without taking a clear-eyed look at what could go wrong, right? So to wrap this all up, let's take a balanced look at both the key risks and the potential upside here.
The analysis is pretty clear about the potential headwinds. I mean, a major global recession could definitely slow things down. Competition in this space is always fierce. And, as a global company, it's always going to be exposed to supply chain and geopolitical risks. These are the main challenges that could get in the way.
But on the flip side, the potential reward is pretty significant. The consensus view from market analysts who cover this stock suggests a potential upside of over 30% from where the stock has been trading. That signals a pretty strong belief that the valuation gap we've been talking about is likely to close.
And so, that brings us right back to where we started, with a question. Kerry Group has done the really hard work of transforming itself into this focused, more profitable leader in a growing industry. The only question left is, has the market simply overlooked the true value of this newly renovated company? That right there is the billion-dollar question.